It's 2025, and nearly $315 billion is being poured into AI, more than doubled since just 4 years ago. Investors and tech giants believe this surge will reshape everything, but echoes of the dot-com crash and the telecom fiber fiasco haunt every dollar spent. If AI stocks are driving 75% of market gains, why do warning signs already resemble the last great bubble? Here's what nobody's explaining about the real risks behind the gold rush and what happens when the hype finally collides with hard reality. Long before artificial intelligence became the headline act, investors chased other revolutions with the same fever. In the late 1800s, American railroads stretched across the continent, fueled by a torrent of capital. Companies raced to lay track, often with little thought to how many trains or passengers would actually come. By the 1870s, the nation had more rail lines than it needed. Dozens of lines went bankrupt, leaving behind empty stations and silent rails, a classic case of overbuilding ahead of demand. A century later, the internet promised to connect the world. In the late 1990s, a stampede of money poured into dot-com startups. Business plans often boiled down to capturing eyeballs rather than building real profits. Pets.com, with its sock puppet mascot, raised $90 million and bought a Super Bowl ad before selling a single dog treat at a profit. At the peak, companies with barely any revenue soared to billion-dollar valuations just for being online. When the bubble burst in 2000, the Nasdaq lost nearly 80% of its value, and thousands of startups folded almost overnight. Telecom giants saw the internet's promise and doubled down on infrastructure. From 1997 to 2001, they spent over $500 billion laying fiber optic cables, convinced that internet traffic would soon explode. By 2002, as much as 95% of the world's fiber sat unused, what people call dark fiber, waiting for demand that would not arrive for years. Companies like Global Crossing and WorldCom collapsed under the weight of their own ambition. The empty cables eventually found a use, but only after a wave of bankruptcies and fire sale prices. These episodes share a familiar pattern. A new technology dazzles, money floods in, and capacity outpaces reality. The pattern is not just about lost fortunes, it is about timing. Even the right idea at the wrong moment can leave investors holding the bill. The dot-com era's eyeballs over earnings mantra and the telecom fiber glut both show how hype can overpower hard math. Each time the promise was enormous, but the payoff took far longer than anyone expected. Today's AI boom echoes these earlier manias. The scale is bigger, the stakes higher, but the question remains, is the world building for a future that is not quite here yet? History suggests that when excitement runs ahead of adoption, the fallout can be just as dramatic as the rise. In just 4 years, the amount of money pouring into artificial intelligence, spelled AI, has soared to levels that dwarf even the wildest days of the dot-com bubble. In 2021, the world's biggest tech companies spent $127 billion on AI infrastructure. By 2025, that number is projected to reach at least $315 billion, a figure larger than the annual GDP of entire countries. The charge is led by a handful of giants: Microsoft, Amazon, Google, Meta, and Oracle. Together, they are known as the hyperscalers, and they are building the backbone of the AI era at a pace that is hard to grasp. Nearly half of all this spending goes into data centers, vast windowless buildings filled with racks of servers, and humming with the sound of cooling fans and power converters. Microsoft alone is on track to spend up to $80 billion in 2025, most of it on new data centers. Amazon is not far behind, with $100 billion earmarked for AI infrastructure that year. Meta is expected to cross $75 billion. Even Oracle, traditionally a database company, has committed over $15 billion to keep up. The next biggest slice, about 30%, is spent on the specialized chips that make AI possible. Graphics processing units, known as GPUs, have become the hottest commodity in tech. Meta reportedly bought 350,000 NVIDIA GPUs in 2024, spending more than $10 billion in a single year. Amazon and Google are racing to design their own chips, hoping to control costs and secure supply. The demand is so intense that chipmakers have started offering deferred payment deals, betting that customers will be locked in for years to come. Another 10 to 15% of spending goes to power infrastructure. AI models are hungry, not just for data, but for electricity. Data centers are now among the biggest consumers of energy in several states, sometimes drawing more power than entire towns. Tech companies are building their own substations and signing deals for renewable energy, trying to keep up with the relentless appetite of their AI clusters. The rest of the budget, about 10 to 15%, is funneled into research and development. This covers everything from training new language models to debugging software and hiring teams of machine learning engineers. R&D budgets have more than doubled at most of the hyperscalers in just a year, as companies race to outdo each other with bigger, faster, and more capable AI systems. Altogether, these investments now account for more than 1% of the entire US GDP. The numbers are so large they almost seem abstract, but they represent real buildings, real hardware, and real bets that AI will change how the world works. For the hyperscalers, this is a high-stakes race to build capacity before their rivals do. The scale is staggering, and the pace shows no sign of slowing. Whether this spending will pay off or become the next chapter in the story of technology overreach remains to be seen. In 2012, Jensen Huang faced a crossroads. NVIDIA, long known for powering video games, was riding high on graphics cards, but inside the company, he argued for a radical departure. Pour billions into developing chips for a technology most people still saw as science fiction, deep learning. Directors worried about the cost. Some questioned whether AI would ever escape research labs. Huang insisted that deep learning would transform every industry. He pushed for an all-in bet, shifting resources away from the company's reliable gaming business toward building GPUs designed for neural networks. Engineers debated the risks in late-night strategy sessions. The research and development budget ballooned, swallowing profits that could have gone to shareholders. The gamble was not just financial. NVIDIA's identity was at stake. For years, the company had been a favorite among gamers and graphics professionals. Now, Huang was asking everyone to imagine a world where self-driving cars, voice assistants, and medical breakthroughs all depended on the company's chips. He faced skepticism from investors and rivals who saw AI as a niche, unproven market. But Huang doubled down, greenlighting custom chip designs and software toolkits for machine learning researchers. The early years brought little reward. Revenues from AI were tiny, and the company's stock lagged behind glitzier tech names. Yet Huang held course, convinced that AI's moment would arrive. By 2025, NVIDIA's faith paid off. The company's GPUs became the backbone of the AI revolution, powering everything from large language models to robotics. Industry analysts estimate that NVIDIA now controls more than 80% of the global AI chip market. Research and development spending that once seemed reckless is now credited with putting the company years ahead of competitors. Huang's conviction, backed by billions in long-shot investment, transformed NVIDIA from a gaming hardware maker into the most important supplier in the age of artificial intelligence. The supply side of the AI boom, it turns out, was shaped not just by demand, but by one executive's willingness to risk everything on the future he believed in. January 2023 in San Francisco. In a glass-walled conference room, Microsoft's top brass faced Sam Altman, the CEO of OpenAI. Both sides knew what was at stake: the future of artificial intelligence and who would control it. Microsoft came to the table with a $10 billion offer, part cash, part Azure cloud credits. But this was not a simple check. The company demanded a 75% share of OpenAI's profits until every dollar was paid back. For Altman and his board, the clause felt suffocating, effectively handing Microsoft the lion's share of any early success. Tension filled the room as lawyers and advisors debated the details. Microsoft's team, led by Satya Nadella, insisted on security for their investment. They wanted to guarantee that Azure would be the engine behind OpenAI's rapid growth, and that profits would flow back to Redmond before anyone else saw a dime. The 75% revenue clawback clause was not just a number, it was leverage, a way to lock in returns and keep rivals at bay. Altman, known for his calm but relentless negotiating style, pushed back. He made it clear that OpenAI had options. With the company's models exploding in popularity, Google and Amazon were eager to host the next generation of artificial intelligence. If Microsoft pressed too hard, OpenAI could walk. The threat was not idle. Altman quietly let it be known that he'd already held talks with rival cloud providers. The message landed: OpenAI would not be strong-armed, even by a $10 trillion giant. The standoff reached its peak late one night when Altman signaled he was ready to take his business elsewhere. Microsoft blinked first. The deal was signed within hours. Microsoft got its 75% profit share, at least until the $10 billion was repaid. But OpenAI secured enough independence to keep shopping for the best cloud deals in the future. Overnight, the entire industry recalibrated. Valuations of artificial intelligence startups soared as investors realized that a single negotiation could reshape the balance of power. The message was clear: in the AI gold rush, leverage shifts in a heartbeat, and fortunes are made or lost on the strength of a single contract. Every AI model starts with a mountain of math and an even bigger pile of bills. Training a large language model means renting time on thousands of high-end GPU cards, each costing between $1 and $3 per hour, even with bulk discounts. A single full training run for a model like GPT-4 can burn through hundreds of thousands, sometimes millions, of GPU hours. That is up to $3 million just for the raw compute, before a single user ever types a prompt. Add in the energy draw, 300 to 400 megawatt hours per 1 million GPU hours. Suddenly, the power bill alone can hit $50,000 per run at industrial rates. But the spending does not stop at training. Once a model is live, every user request triggers a fresh round of costs. For most big models, the price per request lands between 1/10 of a cent and 3 cents, depending on the complexity and length of the answer. That may sound small, but at scale, it adds up fast. 1 million requests can cost $1,000 to $30,000 in GPU time alone. For heavy users and enterprise contracts, providers negotiate lower rates, but the basic math does not change. The more people use the model, the more it costs to serve them. This is where margins get squeezed. Unlike classic software, where selling one more copy costs almost nothing, every AI interaction burns real resources. Subscription plans, like ChatGPT Plus at $20 a month, can actually lose money on power users who ask thousands of questions. The only way to protect profits is through careful pricing, smarter model design, and relentless pressure to make each answer cheaper to deliver. As more companies chase the AI gold rush, the cold reality of unit economics is never far from the surface. In Iowa, a fight over electricity has spilled out of council chambers and into public view. Residents and regulators are clashing with tech giants over new data centers that draw more power than entire towns. Local records show companies lobbying to keep their true energy use out of sight, worried that public numbers might scare off investors or spark backlash. At one hearing, a council member demanded answers about a proposed center's grid impact, only to be met with silence and non-disclosure agreements. Behind the scenes, utility managers warn that another round of projects driven by AI could mean brownouts for local homes and farms. The pressure is not just on infrastructure. Inside AI startups, the rush to raise money has become a race against the clock. In late 2022, Slack messages from Stability AI's fundraising team captured the mood. One read, "Speed over diligence. If we wait, someone else gets the deal." CEO Ahmad Mustak pitched the company as a future leader, even as staff scrambled to build the tech he promised. Former employees recall investors pushing wire transfers with barely a glance at the books, desperate not to miss the next unicorn. The result is a frenzy where environmental strain and financial haste go hand in hand. New data centers can tip the balance of a region's power supply, while startups chase funding in a blur of FOMO, fear of missing out. The signals are familiar to anyone who has watched a bubble inflate. Secrecy, urgency, and a willingness to overlook hard questions in the pursuit of the next big thing. As much as 75% of all gains in the S&P 500 this year have come from a handful of AI-linked giants, including NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, and Broadcom. This level of market concentration is drawing warnings from analysts who remember how the dot-com bubble unraveled. The average forward price to earnings ratio for these leaders now tops 50, far higher than the rest of the index. At the same time, the real-world usage of AI infrastructure is coming under scrutiny. Financial models show that if capacity utilization drops below 40%, the payback period on these massive investments can stretch beyond a decade, turning today's triumphs into tomorrow's write-downs. The math is simple: high utilization keeps the dream alive, but any stumble in adoption could expose just how much risk has been packed into a few stocks in a mountain of hardware. Arguments over the future of AI are often fought in the numbers. Some whistleblowers claim that a few startups inflate their active AI user counts, making growth look faster than it really is. Regulators admit they lack the tools to verify these statistics, so investors are asked to trust what is reported. On the other hand, defenders point out that most of the current spending, especially among the biggest tech firms, is funded by profits, not borrowed money. A Goldman Sachs analyst put it bluntly: "These are not dot-com startups burning cash. These are blue-chip giants with fortress balance sheets." Both sides agree on one thing: there is no clear way to measure how much of the AI boom is real and how much is wishful thinking. For now, the debate remains unsettled. Right now, AI investment shapes the fate of markets, companies, and careers at a pace that leaves little room for caution. As billions chase the promise of intelligence on demand, the risks grow just as fast as the rewards. The future of innovation hangs in this balance. The next move isn't just for investors, it's for all of us. What do you think? Share your thoughts below.